Oh, I know why, because you started the recording. And basically they say when you start recording, you have to agree to it. This. Can Michael hear me now?
The video's off.
Yeah, I can hear you. Just the
I
video.
love technology.
Mike Brzezinski says he can hear you now.
Okay.
There we go. I can see him.
Can they see any screens?
I can see you on.
Okay.
No. See when you're seated behind the podium, can't quite see the project.
Okay. Well, yeah, they aren't probably going to be able to. Let's see. From the beginning. Why is this not working? Pardon me for the technical difficulties here. Like always something. Oh, it's okay. Okay, good. Okay. Anyway, back to our agenda then. So we're going to have then a session talking about revenue recognition. And revenue recognition, then we've had these rules around for a long time. But the question is, we think we know the rules, but do we really know the rules? So it's sometimes a good time to go through because we get lots of questions about when to recognize certain revenues. So we're going to have, a refresher on that. And then we're going to do, hopefully, remotely, Michael from Florida will be presenting on the internal controls for compliance, which is a different type of internal control. And in case you haven't figured out, there's a lot more attention being paid by the federal government about where their money is going and who's spending it and such. And I think it's going to be more important for us all to be cognizant of that, because if you have findings on in your any kind of grant reporting, those grants become at risk, I think, even more so today than they ever have been. So we'll talk about that. And then, I don't know about you, but is anybody else sad to see that free money go away? That free money that the federal government bestowed upon us. Yeah, so that's gone. So we're going to talk about the end of ARPA. We're still expending it, but and then we'll finish up the day talking about how to accelerate the completion of your audit. And then also look at some forward-thinking things going into the future, some trends that we want to talk about and what it might mean for everybody. So with that, I'm going to turn this over to Orlando for the GASB update. And thank you very much.
Morning, everybody. I'm not using the mic, but I'm going to still stand here just for those participants that are attending remotely, that they can't see me, because if I move somewhere else, they will not be able to see me. And then I need to, Brad, it's just using the arrows here.
Yeah, use the arrows.
So nice that Brad started talking about the GASB 34 because it brought in the new financial reporting model. So one of the statements that were recently issued has to do with changes to that financial reporting model, which is the third item here on the list. So that's one of the items that we're going to be covering. The first two items are the standards that are effective now for June 30th, 2025. Then we have the other two items that are effective for June 30th, 2026. It's not exactly June 30th, right? It's just for those June 30th governments that would be the effective days for June 30th governments in adopting the standards. And then we're going to talk about some GASB projects. The first two items compensated absences and certain risk disclosures. We're going to address compensated absences at the end of my presentation because we're going to transition to the Fierce and Tara's section. So I'm going to start with GASB 102 for certain risk disclosures. And then I will follow with 103 and 104. Even I'm going to touch on the GASB projects. On the GASB projects, I have one of them, which is an implementation guide, which when I prepared the presentation, it was still a project, but it was just released. So it's now available in the GASB webpage, the 2025 implementation guide. So, but still, what I'm going to do is I'm going to cover some of those Q&As, including the implementation guide, not all of them. Just to let you know, give you an idea of what's coming in those in that implementation guide. So let's start with GASB 102. The most important thing here is that we are looking at how things are going to be significant to the financial statements, and that's why when you see in the slide, some items are highlighted in this slide and the following, because what the standard is looking for is for concentration or constraints that impose a significant risk in the organization. So probably you can start thinking, doing your own inventory of what this could be in your organization, but you want to look at those that could be very significant to your, could have a significant impact in your revenue streams or your outflows. That's what you're looking for here. Concentration, you can think, here's some examples: concentration of employees, if there's a labor union, concentration of industries, if your organization is in certain particular industry, probably that will apply more to the special districts. But if there's some regulation that could impact your industry, inflow of resources, for example, if you have only one revenue stream, and there is a chance that something could cause significant impact in your sole revenue stream. That's what we're talking about here. And then constraint is limitations imposed either by external parties or by the higher level of decision-making in your organization, in the district, for example, the board of directors or the city council. So this is not looking for an accounting requirement. This is a disclosure. So there is a disclosure will be required when all these three items are met. This criteria has been met. There is a concentration or a constraint. The concentration or the constraint makes the organization vulnerable to a substantial impact. Again, highlighted. If this is going to probably causes let's say less than 5% impact in your revenue stream or in your expenditures, probably that's not significant to your organization. So we're talking about substantial impact. An event or events associated with the concentration of constraint, and this is very interesting. An event or events associated with the concentration of constraint that could cause a substantial impact have occurred or have begun to occur or are more likely than not to begin occurring within the next 12 months. So this is not something that just happened. This may have happened, this may happen in the future, or it is more likely than not that will happen in the future. So here is a wide range of possibilities that you need to consider in order to determine whether you need to apply this disclosure or not to the financial statements. So if that criteria is met, this is what needs to be included in the disclosure. It needs to include a description of the concentration of the constraint, and we're going to see some examples in a few minutes. Each event associated to the concentration of the constraint that could cause a substantial impact if the event has occurred or has begun to occur, prior to the issuance of the financial statements. And then also the action taken by management to mitigate the impact of it. So I think that what needs to be disclosed is not a big deal, right? It's figuring out the events that will require disclosure. That's where the issue is here. So again, you would like to determine what are the significant risks out there or significant events that could impose a significant impact on your organization, and do this evaluation about are they happening now, or could they happen in the near future, and then what's the likelihood that they could occur. Let's see some example here. Probably will be easier to understand this. One example, and these are examples that are included in the standard, the illustrated examples of the standard. This one is related. I just summarized it for the presentation. Illustrative disclosure number one is related to concentration of revenue source. In this case, this is a city that has revenue bonds, and it has an airport. I'm sorry, it has an airport and an airport fund, and that airport is reporting revenue bonds, and the revenues of that airport fund are pledged to the payment of debt. So in this case, the major supplier of the airport fund is saying that the larger supplier will terminate its service within the next 12 months. So this is one fund that has it says that the larger supplier, and if you look at the discussion in the example, it could be understood that probably is the sole supplier, but in this case it's the larger supplier based on the description here. But if this fund, if the revenue is going to be reduced or eliminated within the next 12 months, because the supplier already mentioned that he's going to cease operations or cease providing services, then it's going to impact, of course, the revenues of the fund and the ability to pay the bonds problem. So this is very significant. It's probably a very extreme example, but it's give you a good idea of, hey, am I going to have a significant impact on my revenue? Here's another example of this one is related to spending constraint. This is a district, and is a water district, if I recall correctly. And in this example, there's a regulation that will require the water district to do some significant improvements in the infrastructure. So they are saying, if I need to do that, and the expectation is that the law will be approved within the next 12 months, and then that will significantly impact my my expenditures. I'm going to have a lot of maintenance expenditures, a lot of infrastructure development. So that will cause a significant impact in this case, in my outflows. So they need to probably take some action, increase the revenue, increase the billing rates. And in this example, I want to highlight, for example, that part of the disclosure is to mention what are the mitigating actions that are taken by management of the government. And this last sentence here in the bottom of the slide provides that. It says, September, the board approved an increase in the rates charged to private and commercial customers, partially address improvements to the wastewater treatment plant. So again, something that that significant impact is anticipated based on the facts of this example.
Would you anticipate us disclosing things like the Medicare, Medicaid cuts that might be coming down? That's significant for us.
So, okay, that's significant. So, okay, so would you,
Can you Can you repeat the question so people can hear online?
Yeah, so Mike is saying that if we anticipate that something would need to be disclosed regarding significant cuts from Medicaid and Medicare. Okay, so Mike is already in the position that is going to be significant to the county. So if that's going to be significant, and I think that's what this is going to probably impact your revenues in your governmental activities. And I'm saying that because it says the guidance says that you need to address every single opinion unit that will be impacted. So probably your general fund will be impacted as well, that you have separate fund for this.
Mostly the health and insurance.
Okay, so you have some major funds and some and probably governmental activities. Yes, and then what would be the mitigating factors, if any? Because the requirement is to disclose the mitigating factors. If you look in this other example, if you go into the standard and looks at this example, in this case, that they lost the sole supplier, the revenues impacted, they don't really have a mitigating factor. They didn't disclose it. When I read the standard about if you're required to disclose the mitigating factors, and I doubt that a government may not necessarily, if this is something that impacts your, in this case, is an airport, right? So if the airport is not going to work anymore, it doesn't have the right revenues, you may need to close it. So what will be the mitigating factor? Are you going to find another supplier, or if you're just going to close it and you have no mitigating factors, then you have nothing to disclose in that sense. But something to highlight here is that what you need to disclose is the mitigating factors that have been have taken effect by the reporting date of the financial statements. Meaning, if the mitigating factors are going to take place later, the standard says you're not going to disclose that. That's going to be like looking to the future, anticipating things. So in that case, will not be disclosed. But here, when I look into the discussion of this example, it says that in this case, they just had no mitigating factors. So there's no mitigating factor to disclose. If you would like to say there are no mitigating factors, like disclose it because you want to make sure that somebody who is looking at disclosure is evaluating whether you met the standard requirements, probably that would be an option. But I'm taking this example from the standard, just didn't include any mitigating factors. So in the case of Medicare, if you are not going to have this revenue, how does that impact your operation? Where are you going to
Layoffs.
So I think that will be a mitigating factor because you will not have the revenue to cover the cost of those employees. So now, something that the standard says is if you came up with mitigating factors that would cause any of these criteria. Yeah, if based on the if you came with some mitigating factors that made some of these criteria false, that is not met anymore, like if you take mitigating action before the end of fiscal year, and it doesn't make it results in some of the criteria not met anymore, then you don't need to make the disclosure. For example, let's say that you came with already with substantial increase before the end of the year on your rates, and then you are not going to have a significant impact anymore, or there was a law that was let's use an example is in the control of management, because some of these items could be coming from constraint from the, let's say, the highest level of decision making in the organization. Let's say that the board of directors of the district had some constraint on the expenditures, and they eliminated those constraints so that you now don't have the potential impact that was expected. then you eliminated that substantial impact. And now you're not required to come with that disclosure. Maybe if you did something that eliminates the substantial impact, but now you have a different maybe an increase in your rates or something. That's something that probably you would like to address in the MD&A, or if this is subsequent event, addressing the subsequent event section. But if it is not going to cause a significant impact in your revenue streams anymore, or in your outflows, then you're not required to make the disclosure. So something to discuss during the preparation of the financial statements, because again, what you need to disclose is not that complicated. The issue is whether you identified the events that could cause a significant impact in your organization or not. Any other question on 102? Yeah.
So I'll go back to the Medicare, Medicaid. How do you determine whether it's more likely than not?
The Medicare cuts are current already, right? So the more likely than not has to do with something that has not happened or has not been approved, and you need to determine whether it's going to be more likely than not to happen within the next 12 months or not. So the question is this something that may be approved within the next 12 months? Is something that it's a judgment call. It's a judgment call. I mean,
Because the bill hasn't passed yet.
Exactly.
It's sitting in the Senate, so it passed the House and the Senate, so we are like, I don't know.
okay,
More
so
than likely unless the bill is passed, right?
Right, and every day it's a different story about, is it gonna die, is it gonna go back? So I guess that's where. And I think this is just one example as we navigate what's going on federally of that deal with this. that-
yeah, and we are seeing many changes right now, right? So yeah, so thank you for the clarification, Steve, with the Senate. So the question is, do we know how likely is that this is going to be approved finally? So we don't know. I mean, I don't think that I can make that decision now. I think that's something that would need to be evaluated during the preparation of the financial statements to see what has been the progress. If it has been approved by the Senate, it's just waiting for the president to approve it. It's a president's project. Probably you will say this is likely that's going to be approved by him. So.
Why would this be relevant to the average reader? And it seems like it's more relevant maybe to the bond situation, like people wanting to issue bonds, or if they're wanting to read your financial statements for possible potential risk. It seems like.
Yeah,
I don't know how the average reader would
it's
really
a good
care.
point. It's a good point because there's this, Brad is going to discuss later today, this paper that came out about accelerating the financial statements, and there's a lot of, always debate or discussion about who is the user of the financial statement. Why are all these requirements coming? And when we look at the changes to the financial reporting model, we're going to see some changes that are simplifications. Other are things that we don't know what the need is for that, but yes, it depends. So what is behind this standard is that there was no, other than contingencies, there was no real requirement about or clarity about what to disclose about concentrations and constraints. And this standard came with specific requirements. And again, some of the standards that we're going to discuss today, some of them are just requiring things that in the past were not necessarily that clear to the use. Who will be interested in reading this? I think that it will be more than just the bondholders. If you're going to lose a significant revenue, let's take the example of the airport. Probably this is just whether that city can run the airport, whether they will be able to run the airport going forward or not, because they're not going to have a significant supplier. But what about the employees that are in the airport? So there's going to be other people that could be interested in what's going on and what are the mitigating actions taken by management. But it's just a disclosure, right? It's not a different accounting requirement, but the GASB said that it's important that these things be communicated. If this is, I think I see the value in terms that if this is going to have a significant impact in the financial statements, I see the value of disclosing it. But yeah, there's always a debate about some things that are coming in the standards and who is really getting the benefit of those disclosures and information. Any other questions on risk disclosures? Financial reporting model. So, see, GASB 34 is the one who established the current financial reporting model, right? Where we have the MD&A, we have the government-wide financial statements and the fund financial statements, and there's been some other standards that have been issued that came with some changes here, some changes there. This one is bringing a group of different changes directly into the financial reporting model. So, and remember this one, I'm going to discuss 103 and 104. These two are effective for next year. My recommendation is take a look at these requirements. When you adopt a standard, you need to either adopt it entirely or not adopt it. I'm thinking about if you plan to early implement this standard of the next one, you should consider if you plan to early implement it, whether you are ready to adopt all the provisions of it, because you would need to say, we adopted this standard, and then you need to bring the whole thing in. So the first change is changes to the MD&A. And the way I see this one is that most important thing that they are requiring in the MD&A is a specific explanation of the variances year over year. In terms of, you know that the MD&A, you need to disclose the condensed information about your statement on net position, condensed information about your, let's say, your P&L, statement of revenues and expenses. And you need to present a comparative information of that condensed information. And many times we have seen organizations that they just say revenues increased by this percent, expenses decreased by this amount, capital assets decrease or increase by this amount. So this standard is saying you need to understand that not everybody using the financial statements understand what's happening in your organization, and you need to provide explanation of those variances. And it is said in different sections of the standard. It is the standard is updating or superseding a number of paragraphs from GASB 34, and in different sections of those paragraphs, they are saying that this explanations need to be provided, assuming that the user of the financial statement doesn't necessarily know all the information that is happening in the organization. So, meaning for the CFO presenting information to the board of directors, likely the board knows what's happening in the organization and the CFO knows, and some things are not necessary to be presented to the board or explained to the board. But everybody else that is using the financial statement, we need a little more explanation about what's going on to understand the variances. So that will be on the MD&A. Unusual and frequent items. those of you who have been working on this for many years know that there's a concept that exists only in government that is called special item. So in the past, or until this standard, you had this disclosed either extraordinary items or special items. The special item is something that is unusual or infrequent and is under the control of management. So that is being replaced with a section where you're just going to disclose unusual and infrequent items. That will be the category that will be used. I think this is a simplification of trying to apply the concept of special item particularly, or so that's what's behind this one. Is that's the way it is explained in the standard. So the change here is probably just a matter of presentation, as you can see. The concept of special item that required that something be under the control of management, they said that is not relevant enough for this categorization. It just needs to be unusual or infrequent. Of course, it needs to be significant. You're not going to spend time trying to classify something separately that is not significant. But the component of special item that require you to consider where the unusual and frequent item was under the control of management, it says that that should be addressed or can be addressed in the notes to the financial statement. You don't need to consider that for presentation purposes. So here's an example. It just said it's going to be the last item of inflows or outflows in the P&L, statement of revenue or statement of activities. So here is in a government-wide presentation at the bottom. And here you can see at the fund level, it will be the last item before it's the net change in net position or net change in fund balance. So this is it with unusual and frequent items. It's a presentation matter, but because the definition changes now, the concepts are replaced. But I think that is in an easier way now to address this concept. So when you go to the proprietary funds, there are some changes to the presentation here as well. And this is one that to the question or the comment in this table before about why are some of these things required. This is one that it is explained in standard that they said previously some of these, let's say, operating grants were hidden in non-operating transactions in the P&L. But more than that, I don't see a lot of value. But the thing is that they want to add a category in the P&L of the proprietary funds that will be called non-capital subsidies. That's where you are going to put the transfers in, the transfers out, and any other, let's say, operating grant, which doesn't mean that it's an operating revenue. It's operating grant means that it's for operation, not for capital purposes. So we can see an example here where a new category is added just before non-operating revenues and expenses. And there you're going to include the transfers in, transfers out, and intergovernmental revenue, because it's a grant that or it's an intergovernmental revenue that is non-capital. That will be for non-capital subsidies, and then all the other non-operating revenues and expenses will continue to be presented separately. So that's it as far as it relates to this categorization. Why this was necessary? I don't see that, right? But this is a requirement. Maybe the bondholders, I don't know. So and then those of you that issue an ARPA, you want to make sure that the categories in your statistical section align with this presentation as well. Okay, this one I think is probably a simplification in terms of, it's gonna be just one way to do this going forward. And it is on those of you who have multiple component units. So when you have multiple component units, I mean, let's go with a single component. And I'm talking about discretely presented component units, because you could have blended component units. Those will be a fund in your financial statement. But if you have discretely presented component unit, let's say that you have just one, right? You will be required to present it as one column in your government-wide financial statements. And that will be a column in the statement of net position, and a column in the statement of activities. And then, of course, the necessary disclosures that you will need to apply to the discretely presented component unit. When you have multiple component units, then probably they would not all of them will fit into the government-wide financial statements. And what you were required to do in the past is to present a aggregate column in the government-wide, and then you will need to present a combining schedule either as a statement in the face of the financial statements, right after the financial statements, or in the disclosures to the financial statements. So what this standard is saying is the disclosure option is not going to be available anymore. If you have multiple component units, you will need to present them in the face of the financial statement, in the statement of net position, in the statement of activities, if they fit into the page, right? If let's say that you have one, you have two, you can still probably fit two component units, two columns of component units in the statement of net position, statement of activities. But if you have multiple that does not allow good reading of the financial statement, just put a aggregated column, and then you need to go in the face of the financial statement right after the fund financial statement and present the combining schedules or combining statements in this case. So you will have, in this case, there's two major component units, an energy authority, an airport. There's non-major component units aggregated, and then you have a total at the end. So this will be the combining statement of net position for the component units. And this will be the same example for the statement of revenue and expense or statement of activities of the discretely presented component units. So the option to present this information in the notes as condensed information will not be available anymore. So again, probably this does not impact a lot of you, but this is what comes with the standard. Am I going too fast? Any question? Budgetary comparison information. So I'm going to probably summarize this in 3 changes. The first one, similar to what happened with the component units, is that they are eliminating an option that existed before, and the budgetary comparison information would need to be presented only as RSI. In the past, until this standard, you could present the budgetary comparison information as a statement. And we're talking about the budgetary comparison information for the general fund and any major special revenue fund that's had a legally adopted budget, right? This is what we're discussing is for that requirement of what was considered in the GASB 34 as RSI, and again, budgetary comparison schedule for the general fund and any major special revenue fund that has a legally adopted budget. In the GASB 34, that was required to present as RSI, but was allowed to be presented as a statement in the face of the financial statements. So the presentation of those schedules as a statement is not allowed anymore. The standard said this is going to be only RSI. This is not going to be presented as a statement anymore. And the arguments or the discussion around is this is initially was permitted to present a statement, but there's a difference between RSI versus statement in terms of the audit responsibility and on other reasons. And he said, this shouldn't be something optional. It should be a requirement one way or the other. So the standard came with clarifying that it should be only as RSI presentation. I'm going to the visual examples here. So one thing that they are requiring new is a column presenting the difference between the original and final budget. In the past, there was a column that would present the difference between the actual numbers and the final budget. And that was an optional column. It was presented very, very frequently, but it was permitted, but was not required, but it was used very, very, very frequently, that column between presenting the variance between the actual and the final budget. But now that those two columns will be required. And in addition to that, the significant variances will need to be explained in the notes to RSI. Remember that this is going to be RSI. So in the notes to RSI, the significant variances will need to be explained as well. Here's an example coming from the standard on how to address those variances noted in the budgetary schedule, but doesn't need to be on a tabular basis. It could be a paragraph. The example in the standard is presented this way. If you look at the GFOA Act, for example, they use paragraphs to describe these variances. So the important thing is that you address the significant variances and explain them.
Actual like budget versus tax results.
Yeah, so both will need to be explained. Original versus final, and then actual versus final budget.
And would you have
No, no. If there are no changes, actually, if there are no changes, you can take these first two columns and call it original and final, and then you don't need to present a column. Kathy. Correct. So what Kathy is saying is what we have here. So you know what, that you need to present, you need to include those budgetary comparison schedule for all your funds that are subject to your legal budget. So RSI is RSI. RSI is what is required by the GASB standard. RSI is going to be the general fund, major special revenue fund, and all of this that we're talking about here, the explanation of the variances, the different columns, all of that needs to be presented for RSI. What you need to do with all your other funds does not require all these considerations. You're just going to present the actuals and budget amounts and the actuals.
Have they defined what significant means?
Judgment. Probably some of the items are going to be very evident. Yeah, but yeah. Here, if you look at this here, probably the 1,640, which is, this is in thousands, that will be 1,640,000. That variance in that section at the bottom. The first item is the biggest one. Probably you would like to discuss that one. The other two, I don't know how significant would that be based on the line category. So it would be a judgment call. So that is probably the most significant set of changes that this standard is bringing up. So I think Again, most of it is in some cases could be changing some things that you have done before. What I think is that the information is still there. It's not like you need to come with a new, a completely new presentation or something. Even for example, the unusual and frequent items, those concepts were already part of the special item and extraordinary item. So you will be considering those already. It's just that then they will be named differently, but they will still. One thing that I just remember from unusual and frequent items, those will be presented at the very last section of the statement of activities or before the change in net position or the change in fund balance when you're looking at the fund. But you need a separate line item for each unusual or infrequent item that you would like to discuss. Of course, because they're unusual or infrequent, it's unlikely you're going to have a lot of them. But if it happens that you have more than one, you want to make sure that they are presented separately. Okay. I'm sorry, on this table, what's your name? Stephanie.
Yeah.
Yeah. This is another one that I don't know, Stephanie, why we. So here, what they're requiring here, separate disclosure of certain capital assets. So what they want here is, I think that the one thing that they continue to clarify is that in the past, when the lease standard was approved and then the SBITA and the PPP, they said those need to be presented separately in the disclosure for capital assets. But they are still capital assets, right? So if they amortize and they or depreciate or amortize, we're referring to those that amortize, right? So they're somehow an intangible asset. The leases is a right that you have. That's a right that you have over a property or an asset. The SBITA is another right. PPPs, and then other intangible assets. Also, what they're saying is, these are capital assets. You want those in the disclosure of capital assets. We just want you to present them in separate categories within the disclosure. And if you have more than one of those assets, you want to present it. They say by major category. So you don't need like an inventory of all your assets by code, by individual item number. But in this example, for example, for lease assets, if you have lease buildings and lease equipment, you want to present those separately by line item. On the PPPs, we came with here's two infrastructure items, bridge operation, and then airport operation. Those seems like different categories as well, so they should be presented separately. But you don't want list of all the bridges, right? It's just bridge operation and airport. And then if you have different intangible assets, here we're presenting some, calling them one internally developed software, and the other one intellectual property, just as an example, just to identify that there are different type of intangible assets. So this will, and this is a simplified version of the disclosure because we're not including here. Sometimes we have other categories in our capital asset disclosures, other infrastructure that is not leased infrastructure, just true infrastructure. We may have other type of equipment, vehicles, or stuff that is not listed here. So I think this is going to really take it this time a full page of your financial statement. If you're presenting comparative financial statement, it's going to be 2 pages. And in some instances, I can see also the possibility that it may require even more than 1 page, depending on how many categories do you have. So, Stephanie, we got this. So here we are, this standard is also addressing, so this standard came with 2 things, that requirement on capital assets, and this other requirement on capital asset held for sale. So this is not asset held for sale, it's capital asset held for sale. So what they're saying here is that an asset will be considered held for sale if the government has decided to put it for sale. And then it is more likely than not that the sale will be finalized within 1 year of the financial statement. In this case, for example, at least they provide some criteria to consider, still a judgment call. But this one, they are providing some criteria. They're saying, is this an asset that can be sold? Is there a market out there? Is there somebody that could really buy this type of asset? So they provide that criteria so that you can evaluate how likely is that they can sell this within 1 year. Let's say, for example, that you have information that this type of asset normally could take 10 years to be sold. It's something very, very difficult to find a buyer. So that's information that will be valuable in this valuation. But it still is going to be a judgment call. So then the other thing about this is that what they say is, once you identify an asset that is a capital asset that is held for sale, you are going to retain the category of that asset in your capital asset disclosure table. If this is a building, for example, held for sale, you are going to still report it as a building, but you are going to disclose that you have a building that is held for sale. You need to disclose how much the cost of the asset, the current value of the asset, the amount of accumulated depreciation, and if there is any bonds that are associated with that. Go ahead, Darryl.
This year I have a very fun situation where our sheriff's office has obtained a bunch of forfeited items due to seizure. And so there is no historical cost. We own these assets, but there's no more historical cost. So how would I disclose these assets that are held for sale that we have no money paid into them?
Okay, so say that again. So
We obtained these assets because
for feature.
criminal, yeah, they were criminal assets, and it was determined that they were forfeited and now the county owns them. So we have no cost in them.
And I guess that you intend to sell them because
Some of them we're keeping, which is also another interesting journal entry I have to do. I'm treating it like a donation, I guess, but because we have to put it in at fair market value. The asset we obtained is at fair market value, but we obtained it for free. So.
Yeah, so I think, well, number one, I think that goes beyond or way before this standard. The question is, how do you account for forfeited assets or assets that the government acquired? I don't recall the answer to that. We'll be happy to work with you and Mike and Brad on an answer. Brad, do you know the answer to that? So what I'm saying, I don't recall the answer to this, but this is a scenario. So they have.
Right. Well, my first question is it material to the financial statements?
I mean, they're the value of them are considered capital, so the values are.
Yeah, but look at, because this is appearing in the governmental activities column. So let's look at, is it material to your governmental activities?
Probably not.
Oh, okay, so that's the answer.
That's the answer.
If you can get that answer that's not material, then this.
Ignore it.
Yeah. The other thing, of course, this applies next fiscal year.
So don't worry about it.
So that's what you're.
Make sure that you sell them now.
Yeah, but this is going this year, Mike.
Yeah.
Already solved that. If you really implemented and it is material, then you would, basically the receipt of those forfeited items, you need to record that as a capital contribution. And you'll record then the estimated fair value.
Yeah.
And then that would be the disclosure based on that estimated fair value.
I appreciate it. Thank you.
Yeah.
Okay, so those remote participants, I doubt that you heard the discussion, but we're talking about asset that by this county were forfeited. And the question was, what will be the value of those forfeited assets in the books to determine if they need to be recorded as an asset held for sale because those forfeited assets will be, the intention is to sell them. Under that scenario, again, there are other considerations about materiality, about whether the standards for next year, whether they will cross this year and they will still available for sale next year. There's other considerations. But then the question about the value of those forfeited assets goes far before this standard because it had to do with how do you record forfeited assets, assets that have been forfeited by the government. So our response here was that they need to be recorded as capital contributions as per bucket. So assuming that was the amount that you recorded them and that you need to implement the standard and have those assets held for sale, then you will retain the category of the asset the way it was recorded, if it was building or other type of property. But then you need to disclose in the books if it had any accumulated depreciation or something else that need to be disclosed separately. Okay, thank you, Darren. Okay, and here's an example of how you can disclose the information related to the asset held for sale. Again, it doesn't require different classification in the financial statements. It's a matter of making sure that you disclose, to Brad's point, if this is significant to the financial statement. If it is not, this is new, right? You're not going to disclose things that are not material to the financial statements. Okay, I'm moving into the GASB projects. I'm going to the GASB project now. Again, this first one that I'm addressing is not a project anymore. It's an implementation guide that was just released. So I'm going to just touch on some of those examples that probably will be practical for you to consider. The first one, so this one is, the question came as to, is there going to be a specific format in the order of things that need to be presented in the MD&A or a format of the presentation? And you may recall from GASB 34 that in paragraph 11, you had all the things that were required to be included in the MD&A. The condensed information, the explanations, the capital assets discussion, the debt discussion, all of that had to be included in the MD&A. So, and then it was clarified in our standard that you should be including other information that is not listed there. So, because the standard is superseding some of those paragraphs in GASB 34, they use this Q&A to say, yeah, there's what you need to include in the MD&A is what is included in GASB 103 in these paragraphs. So it's not going to make reference to GASB 34 paragraph 11 anymore. It's going to make making reference to GASB 103. So in essence, it's just making sure that you are following what it says here. Nothing else should be included in the MD&A. This one is, this is something interesting. You know that in the government world, it's a common practice supported by the standards to use a capitalization threshold, and you're encouraged to do that because accounting for things that are immaterial to the financial statements, again, it's not the best use of your resources. So it's a common practice, and you're actually encouraged to be updating that every few years. You shouldn't 30 years after still using the same capitalization thresholds that were relevant 30 years ago, capitalizing everything that is over $1,000, $2,000, right? So you're also encouraged to be updating that. So you may recall that one of the recent standards that what issue was related to corrections of errors. And the question is, if you change your capitalization threshold, let's say that you're increasing it from we are capitalizing everything over 5 million. Now we're going to increase it to $10 million. is that something that needs to be corrected retroactively? And this Q&A said, no, this is not the correction of an error. This is you applying prospectively your materiality standard and materiality policy in your organization. So you're just going to implement it and you're going to start capitalizing under your new threshold things going forward. So you don't need to change things in the past. So I don't think that I see anything addressing the disclosure about it. I think the disclosure is your new policy and you just update it. But that's what this is clarifying. You don't need to address it as a correction of prior year numbers or balances. Okay, I addressed this one already. Okay, again, touching on that standard that addresses correction of prior year errors. One thing that this is clarifying is that in the face of the financial statements, you are going, assuming that you have multiple corrections of errors per opinion unit, right? Because you may have one correction in a governmental fund, one correction in a proprietary fund, and this is going to take just one item in the face of the financial statements. But let's say that for some reason, you had 3 different corrections in one single opinion unit. You are in the general fund and you have to correct 3 things. One related to ARPA, another one related to some capital assets, something else. You need to present in the face of the financial statement one line item that says correction of error. And then you go to the disclosure of the financial statement and you put the breakdown in the disclosure to the financial statements. So, and this is another one that is, I wanted to bring because it goes beyond this particular requirement. I'm happy to see this Q&A here. It says, our government is required to use special revenue funds to report restricted or committed revenue sources. So unless, as it says in the response, unless it is required by law or only there is a particular requirement to present that revenue stream in a separate fund, legally required, somehow required. You do not need to present special revenue funds for all your revenue streams that are committed or restricted. So if you look at the GASB 54 disclosure, it says special revenue funds are those that can be used to account for this information and is by revenue source, right? Either we know that many times those funds, you're thinking about the activity that will be happening or running through that fund. Let's say an ARPA fund, for example. You're going to put that money aside, and there's going to be some activity related to the ARPA fund there, and you may have the revenue there, you may have it in another fund. But you are not required, unless mandated by law, you are not required to use special revenue funds for your different revenue streams that are committed or restricted. So it's something that you can do. You can keep everything else, unless required by law, you can keep everything else in your general fund, and probably you can save a bunch of special revenue funds being presented in the face of the financial statements. For compliance purposes, you are going to present all of them separately in the supplementary information section. But in the face of the financial statement, talking about the GAAP requirement, you don't necessarily need to have a separate special revenue fund for each of those. Okay, the three. I'm moving now into the other projects that are being worked by the GASB. Subsequent events is one of them. GASB says that there's some inconsistency out there. They want to put some rules out there to define what should be disclosed as subsequent events. Going concern consideration, this is very particular about, what is triggering this is the particularities related to the government, because a government may cease to operate, but it's not necessarily going to happen because of financial difficulties. And we have seen governments that that went bankrupt, and there's a process for them to come back and continue operating. But some government, particularly districts and smaller governments, can cease to operate. So this standard is going to establish a distinction between what is financial stress, what needs to be disclosed about financial stress, significant financial stress, versus a government inability to continue operating. So it's very particular, because in the private sector, you have no money, you just cease operating. It's in rare circumstances, you are going to find a good reorganization and coming back. But in the government, most likely you are going to continue operating, but then it says, okay, you're not going to cease operating, but you are having significant financial difficulties. You cannot pay your debts when due. What you're going to do is this. Does it mean that you are not required to pay to disclose anything or anything up to the users of the financial statements? So this is going to address all those different angles of financial stress and going concern. And then there are some changes coming for infrastructure assets as well. And revenues and expense, it's hard to believe that after all these standards that have been issued, the GASB is revisiting revenues and expenses. But we'll need to see what's coming out there out of this. GASB 101. Okay, so this one, as I said, I'm going to start talking about the requirements, but then I'm going to move these to Fierce and Tara. They're going to discuss some examples on so let's talk about the changes first, because in the old guidance, it was pretty easy to identify what should be recorded as compensated absences, because the most significant attribute was to determine whether an employee leaving the organization will have the right to take the money with them, right? So that was what would the most significant consideration. And if somebody in your organization didn't have that right yet, that benefit, but could acquire that benefit after serving a number of years with the organization, you had to estimate also whether that person which reached that level of experience with the organization and would acquire that right again. And that wouldn't be that had to be considered in the accrual of compensated absences. So under the new standard, that continues to be reported as a long-term liability, like it's going to be part of the government-wide financial statements or the proprietary funds. But the definition is going to change. They are coming with a more ample definition. Now they are including other type of absences that under the old guidance were not very evident or were not addressed specifically in the old guidance. And for example, PTO, that could be vacation, that could be sick leave, but it could be a combination of the two, right? And it wasn't addressed that way in the old guidance. What do you do with holidays, parental leave, and certain types of sabbatical leave? So they are addressing all of that now, and they're coming with a definition that should be able to let you address all these different scenarios. So a liability will need to be recorded if it is attributable to service already rendered. That's consistent with the old guidance. If the leave accumulates means that it can be used in subsequent years. And it is more likely than not that it will be used. So it will be used or otherwise paid on settle. So for vacation, it is very evident, right? Vacation is pretty consistent in all the organizations. You accumulate the time, you are going to use it. You may lose some a portion of it depending on how many days you accumulate, but most of the vacation will be either used or paid or settled at some point. So the question is, what do we do with the other type of leaves that accumulate and may be or may not be used in the future? And the significant player here is sick leave. What happened with sick leave is that in most organizations is something that you use. I'm sorry, you're going to use it only if you get sick, but you're not necessarily going to be paid for the unused time, right? That's the norm. And the question is, okay, if it is going to be paid off, if not for not being used, then it will be pretty similar to vacation time, right? But if it is not going to be paid off, you just lose whatever time you accumulated but didn't use. Then the question is, the standard is saying, yes, but in your experience, there is still a chance that you are going to pay some of that sick leave. The fact that you don't know now who is going to get sick and how much you are going to be paying to those persons for the time that they are going to use in the future, you need to come with some type of calculation of that. And that's where First and Taro are going to talk about that. I'm not going to go into the detail, but the GFOA came with some examples of how to estimate that time based on experience. There's the method that are going to address that, but that's where and I have some slides here addressing this type of leave that have not been used, right? Because if they have been used, just need to pay that out to the participants. So the issue is with the time off that accumulates that is likely that is going to be used and that has not been paid, of course, has not been used. So then we have, again, more likely than not consideration here. And if, let's say that you're preparing, for some reason, you're preparing the financial statements a year after the year end, let's say that let's say that you lost your control or something and you are now in June 2025, you're preparing the 2024 financial statements. You have a lot of information already for a lot more likely than not evaluation as to what happened during this year, that you can go back in 2024 and say, okay, I know a lot of people who use the sick leave. I have that information. You can consider that in your calculation of June 30th, 2024. But the question is, now you are in June 30th, 2025, and you need to come with your financial statement timely. How do I come with that number of sick leave that is likely going to be used by some people? And the standard says that I need to accrue them. So that's going to be an estimate. So, and every time that you see the phrase more likely than not, we have said it's a judgment call, but it also means that this is an estimate. Depending on how much does that represent to your organization? If you just have just a few employees on a big organization, probably that's not going to be significant estimate to you. But if you have your organization that has many employees for the size of it, then it would. I had a client before that was a controller's office, like in this jurisdiction. So they were like an audit firm, right? They had little infrastructure, just a list building, but they have a bunch of auditors auditing the counties and districts and everything else. So everything related to personal cost was significant to them. Compensated absences, pensions, OPEB, liquidation, liquidation of personnel, see if they had to let people go. All those accruals were significant. So every estimate that is embedded in those type of calculation was considered pretty significant to them. But again, it's a consideration of materiality in your different organizations.
Is it an estimate by person or is it an estimate? So I have a gazillion sick hours, right?
Mhm.
But we have employees who use their sick every time
Uh-huh.
with every
Mhm.
pay period.
Mhm.
Is that an estimate to say that in my case, it's not more likely than not that I'm gonna use it, but in Sally's case, it is? Or is it organizationally wide that we somehow create an average?
Yeah, it is unlikely that you can do it on a per person basis because you would need to guess who is going to get sick,
Yeah,
right? So, so you will need to consider, your experience paying sick leave to your group of employees. And I don't want to get too much into the detail of what they're going to address, but, the GFOA came with two examples. Both of them are based on historical experience. One of them is based on number of days that were paid, and the other one is based on dollars paid. But there's multiple considerations to that. Have your if you're doing that, have your the size of your headcount change over the years. Let's say that you have been paying $50,000 in sick leave during the last 3 years, but the last year you lost half of your employees. You cannot accumulate $50,000 this year.
So, I guess, I mean, dollar for dollar, if they're not, it's not impacting your wages paid because they're using sick instead. But it seems more of an analyst tool as far as are my employees, this is the average that my employees are using per year and I'm accruing back.
Yeah.
Sick leave, but they're actually not working
I'm sorry, what was it?
because they're actually using the sick leave. So that's actually days away. But I mean, dollar for dollar, it's not an impact to the organization, but you're accruing back the
Well,
the
yeah.
average of sick leave.
If you think about that during the year, you're paid one thing or the other, right? You're paying, either you're paying the salary or you're paying. So this is a matter related to cutoff, what you are going to accrue at the end of the year. During the year, you're probably just running on a cash basis. I'm paying the employee. It could be sick leave. I'm going to reconcile that later on. But the thing is, at the end of the year, you're going to do your cutoff of what will constitute compensated absences. And then you need to consider what was the actual time that they took. What is, so depending on how you can get your information from your system. No, it's going to be hard. I'm referring to these two methods suggested by the GFOA, but I don't think that they are meant to be the only two methods, right? They're going to be discussed here. I think that the important thing is you're going to come with a reasonable way to estimate because it also depends on the ability of getting the information from your system as well. And for example, this is going to simplify the disclosure of the roll forward of accrued compensated absences in the long-term schedule that goes in the notes to the financial statements. But you know that in the roll forward schedule of compensated absences in the notes, you need to include what were the increases during the year of compensated absences, meaning how much compensated absences were accrued during the year versus the decrease that likely is going to be everything that you pay during the year. So this is a gross up of the movement throughout the year. Some organizations, it's easier for them to calculate how much compensated absences they accrue during the year. That would be decreases. Some of them say, no, for me, it's easier because my system, I can ask my system to tell me how much sick leave was paid or vacation was paid, and I can calculate the decrease in that roll forward easier, and then the increase will be applied probably. That whatever is easier for you to grab that information. So it depends on what your system is going to give you. But one method you're going to use here is going to be an estimate, and and you just need to come with the most reasonable estimate. For example, one thing that you can consider is I have a group of employees that normally use sick leave more than another group. So one of the examples that you're going to hear today, consider the different layers, because there's probably difference in the use of the sick leave, but also there are differences in the compensation. So if you are trying to come with a percentage of the sick leave that could be used, there are going to be differences also in the dollar value that you are going to apply to that accrual, and it needs to be based on the salary rate at the end of the fiscal year. So you cannot assume that if it is going to be paid in the future and there's an expected increase in salary, you're not going to use the future. But at the same time, you need to consider that in the past, the compensation was paid under a different salary rate. So there's a lot of, when I look at this example from the GFOA, I found them like, I would say pretty detailed for not saying pretty complicated. But the thing is that because you are coming with an estimate that could be significant to your organization, you want to make it as strong as possible, the calculation, to make sure that it can be sustained. So what I'm saying with that is that the complexity of your calculation probably would depend on how sensitive is your organization to any potential error in this calculation.
So I guess it is, again, probably this is similar to most people. In my mind, this is merely a liability of productivity. Because it is not a liability that we owe in addition to any other payroll costs we've already budgeted for. Because it's if they take sick time, so it's, whereas vacation in our case is, if everybody walked out the door, we would have to pay them. Sick time, that is not true. So we are merely booking a liability of a lack of productivity.
Yeah, I'm going to give you a more extreme component of what you just said. And this one,
People, potentially. So if everybody called out sick, then all of a sudden now you have to bring in people. So I mean, you could argue that too.
so this is also in the standard. This is meant to be less, to your point, yes, I get it. But what the standard is trying to do is for consistency in terms of benefits accrued by them, is going to be a benefit no different than vacation in terms of they have accrued the time, they are going to have a leave. Vacation is also lack of productivity, right? It's time that the people need to cool down and then come, but it's lack of productivity as well. So it will be pretty much the same concept. The thing is that it's a benefit that has been accrued, and the difference with what used to happen before, or the difference between the two concepts is that you know how much vacation probably they are going to use. You don't know necessarily how much sick leave they're going to use, but it's still a benefit. It's still a lack of productivity, and you need to accrue them because they earned that right already.
To me, I envision that being a little bit even inaccurate, like hard to come up upon right now, because we have the institution of the PLO, the plea bargain, that's causing people to use their sick leave at a different rate than they used to. And so even this historical data, like how do you incorporate that change into your?
Right, you need to incorporate those things that you understand are going to change your experience. That's right. And again, as I said, the example from the GFOA is very detailed, again, for not saying very complicated. But the thing is that they are telling you, you need to incorporate in your calculation all these things that you think are going to impact your calculation. You want to do it as strong as possible of a calculation that you can, that when you come back, when you come to the actual disbursements in the next year, you stay as close as possible, right? It's going to be an estimate. It's not going to be an exact number, but you need to consider all those things that may impact the actual outlay that you're going to have. So this other section here, this one came in, we were having the same discussion internally in the firm the other day, and one of our employees brought this topic out. What do you do with those other leaves that are more sporadic, that are on a per person basis, that are not necessarily, they have the benefit, but they are not necessarily, this one is more blind in terms of who is going to use it versus sick leave. Normally sick leave, I mean, at least for a doctor's appointment, you know that somebody will take some time off for a regular doctor's appointment or something. So, but these are all leaves that are less likely for you to predict. So parental leave, military leave, jury duty. So it is a bit confusing because it starts saying this is not going to be including your accrued compensated absences, accruals. It's not going to be calculated the same, except then I explain you are going to accrue those when they start the leave, considering that some of these leave are limited in time. So, for example, in the parental leave, let's say the person had, I'm don't know exact rule, but let's say the person has 6 weeks. I don't know how many weeks are, but the person has 6 leave for parental leave, and it started the last week of June. You need to accrue because that person already started the leave. You are going to accrue the 6 weeks of, and the person is going to be out there, but it's a benefit that the person has. You know, you're going to pay it. You're going to record it when that person started the leave. And there could be, and there's a concept embedded in the standard that says you can do that with leaves that are limited in time, that you know that when they are going to end. If there's a leave that the person, you don't know when it's coming back, you're not going to accrue anything for the person. You're going to accrue whatever benefit they can get immediately, but if there's no limit on the time, you're not going to accrue. You're just going to disperse it as it goes. But that one came a bit show up a bit confusing at the beginning, because the particular thing about this to accrue them when they begin is that they have a limit on how long they're going to be out. Otherwise, they wouldn't be accrued.
So, my understanding too is that we have to accrue for every holiday.
No, holiday, no, that's a different exception. Holidays will be expense when taken. Holidays, it just happened when it happens, and you're not going to approve of that. It's these other leaves, that's why it's confusing, because it starts saying these days that depend on sporadic event, on that they are not going to be accrued as this as I think it says paragraph 9. But then later it says now whatever has a limited period of time like this, once the person starts the leave, then you are going to accrue that time. And one thing, this is something that you can also consider materiality here, because let's say that it is the end of the year and you have one person that have militarily, would that be significant to you? I mean, the right way to account for it would be accruing that time now. The question is how many people will you have under these exceptions? If you have a few, then probably you would like to account for that, Carly. It's a good point. Don't know the answer to that to see if that sounds like a day that you owe to that person. If somebody knows the answer here, raise your hand. I don't know the answer to that. I think that probably would be.
We do it. We kind of does.
You just accrue it, right? Yeah. I think you owe it to the employee. The thing probably, that one again would be probably materiality If you had to ask all your employees to work in a holiday because we're closing your books, probably that would aggregate. But I would think accruable, I just don't recall from the top of my head, but thank you for contribution.
Just. Give the new definition slide.
Sir?
The new definition slide.
Right, so what it is saying is that it is addressing the standard. So, but then you need to go down into all these criteria to see how each of these items are going. For example, vacation, PDO, sick leave are going to be accrued one way, parental leave is going to be accrued different. Holiday is a leave, but it's going to be paid when used, or if not used and they had the right, then accrued. Another thing to consider is that, again, going to the calculation of the EFOL, that you will see it in a practical way there, but you need to accrue all those payroll related amounts that you would normally accrue for those leave. So if for those leave, you need to accrue like defined contribution benefits, then with the accrual, you need to aggregate all those extra benefits, social security, taxes. And what you cannot accrue is contributions related to defined benefit plans, because those are part of these other estimate on the GASB 68 or GASB 75. So or you have contributions related to defined contribution plans that are normally tied directly to the compensation of the employees, you will need to consider that in your calculation. Jonathan?
Austin has a question from online. We only ever had full-time people for compensated absences. Now it looks like everyone will have to add their part-time employees as they accrue sick. So if we only give employees 20 hours of personal hours every July 1st, we have to add those 20 hours as a compensated absences as of 6/30.
Okay, let me see if I follow you. So they are saying that part-time employee have a right now to compensate absences. Is that the point?
They give their employees 20 hours of personal hours.
Hold on a second. Right, we need to plug this on.
Well, my thought would be.
No, we need to plug this. It's running out of battery.
I thought it was plugged in. Oh, you know what? You gotta turn,
Okay,
you
okay.
have to turn the power switch on for the charge.
Thank you for the advice, Brad. I didn't know. Okay, so Jonathan, sorry, going back. So the question is, so they, in addition to the salary employees, now they have part-time employees that are going to have a benefit. Is that the point?
It looks like it.
So I'm going to address it if that person can follow up, if I didn't understand the question and wants to follow up. But I think that what that person is saying is, now I have part-time employees that also have a benefit of compensated absence. It's going to be 20 hours or something. So if you're asking yourself, hey, how do I consider that? That's something that definitely needs to be considered in your accumulation of accrued compensated absences, because your point is, as of June 30, 2025, I know that now there's a new group of employees that have a right to this benefit. And you can not only rely on the prior experience, you need to incorporate that. How much would those employees will have accrued? If they just got the benefit, I don't know how much do they have they accrued as of today, but that would depend on how many days they have as of June 30, 2023. But it's a good point in terms, if I am understanding the question correctly, that when doing your calculation, you cannot just rely on prior experience, because now you have this one is another fact that needs to be considered. Another group of employees that didn't have the benefit before. So you will definitely would like to consider in your calculation that increment related to those employees.
Their follow-up is, but full-time employees earn 20 personal hours every July 1st. So on June 30th, their compensated list, do we add those 20 hours? We did not before, as they are not paid out on termination.
Oh, okay, so, okay, I think that I'm following. In the old guidance, it said that you are going to pay those if they have a right to that time upon termination. I think that what the guidance says now is, you need to estimate if they're going to get paid for that somehow. It's not if they have the right necessarily on termination. Are you going to pay those based on your experience? And that's an example when you look into experience. It says in your experience, normally, people use 20% of that time or 10% of that time. So that's what you consider when doing this calculation. What has been our experience paying that time, that even if, when it wasn't accruable in the past, some people will get to be paid for that time. So this time they're saying, because you ended up paying for that time anyways, you need to calculate that. You need to incorporate that in your calculation.
I get the question because basically they're fronting sick leave. It's not being earned, they haven't earned it, they just get flown. And I would assume that doesn't really matter because now it's considered theirs. That's my guess.
They will still have to make that.
Yeah, I'm sorry.
If somebody got hired, they got fronted 40 hours of vacation time.
Uh-huh,
That doesn't meet the normal criteria that they're earning it as they go by.
right,
It's just fronted.
right. So
But I would think that would still.
my point to that is, as of June 30th, is how many time they have accumulated, how much time they have accumulated.
All right, so let's see, what else do we have here? This is what I mentioned earlier about, so in terms of the calculation, I just addressed the most, the bulk of standard in terms of what needs to be done with this standard going forward in terms of the accrual, and what needs to be accrued, which should not be accrued as of the end of the year. But then this is something related to disclosure that is a simplification. I was mentioning earlier today that until this standard, there's a requirement to, in that line item of accrued compensated absences in the long-term debt disclosure, long-term liability disclosure, you have to disclose the additions and deletions. And that requires some additional effort and understanding how you can get that information from your systems. So this standard is saying now you can just present that as a net change in one of the columns, as long as you disclose right after the table, the disclosure, that you are presenting that net. So for those of you who had difficulties, so it took you some time to grab that, to determine what those gross amounts were, you can just do this now and it will be much easier. That's in terms of disclosures. And this is in terms of the standards that are coming for this year and for next year. Any question, any other question right now? We'll be more than happy to address any of these topics separately on your specific case. And some of these will require, I think that everything else that we discussed is relatively simple. Probably accrued compensated absence is the one we're going to spend more time figuring out how to make those calculations. But now I'm going to leave you with Pierce. He's going to start addressing those samples I was mentioning.
Thank you, Orlando. Just by show of hands, does any of your organization have like employee contracts that require you to pay cash on any of the CPU? Why? Just all right. Is it full cash settlement or is it half?
It's percentages based on
your balances, basically.
A percentage of your balance. Is it the same for you?
Yeah, we have 2 union contracts where if they're not police and fire, they get 25% of their sick leave paid out at retirement only. So it's very
Retirement.
limited. Yeah,
Okay.
it's a very small number of people.
All right. How about any policy that allows donation of leave to people? Yes, okay. How about a policy that allows or requires payment to a contribution plan? Using the sick leave.
Oh, yeah,
Oh,
sick leave, yeah.
fire.
Yeah,
Okay.
police and fire, you report sick leave
Right,
hours too.
Okay,
Report to first, but that's not a conversion of dollars into,
It does increase their pension benefit.
on that calculation, but
Yeah.
that's not a cost to the county.
No.
right, okay. I just wanna know, because that may complicate your calculations when you're doing the estimate. All right. All right, so I'm just gonna cover very quickly the GFOA tool. And if you haven't seen that, I could give it to you if you can, give me a heads up later, or you could contact your auditors. If you ask for the template, I could give that template. You could download it straight from the GFOA materials section or library. They've issued one in the latter portion of 2024. They've also issued another template just 2 months ago. But I'm only gonna cover the one that they have uploaded last year. All right, and the GFOA provided a caveat there saying that even though they've uploaded the tools, they may not be the best option that's applicable for you. So it really depends if you want to adopt the tools or you want to create your own. All right, so the GFOA urges all governments to apply their best professional judgment based on the unique facts and circumstances to determine the most applicable or most appropriate application of GASB 101. And it also says to consult with your auditors or other appropriate parties. All right, so the tool that was issued last year talks about 2 approaches, and Orlando kind of gave an introduction earlier. The first one is dollars paid approach. And this is based on the historical experience with your former employees. So if you think that your experience with your former employees reflects or best represents the current landscape or environment of your current employees and how they're going to use the sick leave moving on, then you could use this approach. Another approach is if you don't think that the experience with your former employees reflects your current environment, then you could use your historical experience with your current employees, and that's the days use approach. And if you think that it's a mixture of both, then you could do an average, and Tara will show that later, how averaging could work for a company or for an organization, I mean. Just a note that the tools that was issued by GFOA assumes the use of sampling. And so if you're a small organization, you can definitely capture all of your employees if that's easy for you. If you're a big organization, then yes, a sampling method was suggested by GFOA. All right, so the first one that they said is about dollars paid approach, and this is based on the cash settlements made to terminated employees. Right, so the keyword there, former employees. Basically, the tool allows you to select a representative sample of former employees to estimate the portion of the leave time used and the leave time that was settled. So the end product of each tool or each approach, regardless if you use the dollars paid approach or the days use approach, is you're going to come up with a probability percentage. What is the percentage that your former employees used their sick leave before, and what is the probability that your former employees catch in your sick leave at the termination date. And it says here that the size of the sample is a matter of professional judgment and statistical validity may be a consideration. It may also be a scenario where you could probably segregate your employees by demographics, characteristics, contracts. If you think that this union contract and everyone in here has a different trend or experience, you could do that. So again, this is a matter of professional judgment. Just an overview of the dollars paid approach, and I'm not gonna go into the detail of the tool. It's just what happens when you're using the tool. So the first one is when you select the first step is when you select your representative sample of employees or former employees. You have to pull the data of their hiring date, hourly wage, their hourly wage during when they were hired and when they were terminated, in order to come up with the average daily pay during their tenure and the daily rate at the date of the termination. Now, of course, that is if you could pull it from your system, right? Like if you have manual accounting before, it may be really hard to do this. And so you'd have to think whether you could even apply this approach to your organization. The second one is pretty standard and it's applicable to any approach that you use or tool that you use for estimation, is that you make sure that you're also including salary related payments. And I think the mistake before is that, oh, I'm only gonna pay him his pay rate. But no, where you're also paying for Social Security, Medicare, any contributions to the defined contribution plan. Right. And when you're using the dollars paid approach, this is based on your former employees. And so those are prior years dollars. And because these are like from prior years, you need to convert it into today's dollars. And in order to do that, you need to also select a basically your what is this? Your factor, which is your present value factor, to go into your calculation and convert your former employees' payments and settlements to today's dollars. And from there, you could calculate it should be the percentage of the dollars used over the dollars that were earned and the dollars that were settled in cash at the termination. And yeah, and then you would apply that percentage to the I see the food, sorry. And you would apply that percentage to the whatever has been accrued or earned by your employee as of the financial reporting date. So if you're an organization, you still have to pull all of the data as of reporting date and as of the beginning of the reporting period, because you're also doing a prior period adjustment or a statement. And on top of that, you need to determine or estimate the rate that you will apply. And I guess for organizations that don't have to settle in cash, your calculations would be a lot easier than those who will have those complexities, I'd say. The second approach is the days use approach. And this one assumes that the historical experience of your current workforce reflects the current environment and the trend that will likely happen in the future. So if you think that that's applicable to your organization, you can use this approach. Again, this is also a selection, representative sample of active employees and their hourly pay rates at the end of the reporting period. And this is how it looks like in the template. In the template, they were able to pull 5 years of historical data. And so that's another question for your organization is, does your system allow you to go back 5 years to, to calculate a better, I would say, estimation of your sick leave liability. Right, and it follows about the same concept, same as dollars paid. It's just that it's using your current workforce. And without the complexities of the cash settlement, that definitely gives you a little bit of relief when you're doing your calculations. There's also another tool that the GFOA uploaded. It's called FIFO and LIFO results tool. I wasn't able to download this for this training, and so it's just if you also need to explore this tool, we could give it to you. We could download it straight from the GFOA and send it to you. Questions so far? So that's just the two approaches that GFOA shared with everyone. And then I'm going to turn it over to Tara, who's gonna showcase what they did for I would say, a large municipality that had multiple employees and a little bit of complexity in their payroll.
Hello, everyone. I'm Tara Williams. I'm from Yamhill County. Little background, we have about 700 employees with 5 union contracts. We have vacation sick contracts, and we have like a PTO contract, 3 of our contracts. So we have all the leave plans. Okay, my agenda, I'm going to go over the aspects of GASB that I use to determine the liability, our leave plans, my historical analysis, kind of similar to what the GFOA recommended, how I did the calculation, what I considered for the rate of pay, how I turned that into determining expenses by function, because, okay, you can get a liability for your government wide, but you also have to expense it by function, and we have multiple functions. And then, of course, future considerations. So what I looked at when I was looking at the GASB is I need to look at leave that is attributable to services already rendered, leave that accumulates, leave that is likely to be used, that was the key new term, used, not just paid in cash, whether it is dependent on a sporadic event or if it's taken on a specific date. So when I looked at all these aspects, I looked at all of our leave plans and I determined which leave plans were eligible and which leave plans were ineligible. We kind of went over this earlier. Holidays, floating holidays. Our floating holidays expire June 30th, thank goodness, because otherwise we'd have to do an accrual for floating holidays. But all of our floating holidays expire at fiscal year end. So we have comp time, flexible earned time, which is very similar to PTO, paid extended leave, vacation, and sick.
So Tara, on the floating holidays though, they'll get new ones July 1. So there's not a liability that says that
they didn't have them on June 30th. They expired on June 30th. They get new ones on July 1st, but at June 30th, their balance is 0, according to all my contracts. I can see your argument that yes, on July 1st, but yeah, at June 30th, all their balances are 0. That's my logic and I'm sticking to it.
I guess I'm trying to apply the same logic to the whole idea of sick, right? That they earn and they potentially use X going forward, and that's how we're determining.
Because they have those hours at June 30th. So they,
fair enough.
Yeah, that's how I use that logic.
Also have.
No, they expire.
They,
It's use it or lose it, so they go away.
Yep, they are forfeited on June 30th and they accrue again on July 1. They have to use or sell them. Most of my contracts can sell them. Some of my contracts can't sell them. It's very fun.
Leave us out.
Admin leave is out because that is a sporadic event. You only put someone on admin leave for a sporadic thing. Same with
No,
bereavement.
different text, sorry, different admin leave.
Oh, got it. Okay. So during my historical analysis, I did 3 different reports. I did a giant report where I found all of the leave that was used or sold by leave plan for 5 years. And then I said, okay, how much leave is either used or sold on average per year? That was one report. Then I said, okay, leave is forfeited at termination. I can't accrue a liability if the leave is going to be forfeited. So then I looked at how many people by leave plan are terminated each year. Then I said, okay, of those people, when they left, how much of that leave was forfeited? Bear with me. This is where you get the meat. So I use sick leave because sick leave is the hardest one. It took me forever to figure this out. So of entity-wide people who qualify for sick leave at Yamhill County, I determined that 7,500 hours are used per year. I also determined that people who have sick leave, 13% of employees leave a year. And of those people who leave, 99% of that leave is forfeited. Like I said earlier, I have a very specific contract that says 25% of sick leave is paid out at retirement. I had one person in my 5-year analysis that had 25% of their sick leave paid out. So that's why it's 99.58% forfeiture rate. Otherwise, it's 100%. Most of the time, sick leave is forfeited 100%. But because of that contract, I have one employee. So I built a schedule. I said, okay, at year end, I have 35,000 hours. I know next year, based on my averages, 7,500 sick leave hours are going to be used next year. That's my current liability. 7,500 hours is going to be used within the next year based off of a 5-year analysis. How much of that leave is going to be forfeited? 12.9454% because it's 13% times my 99.58%. So that already know, not going to accrue a liability for that. Then now I have an ending balance. Now I go, okay, I got to bring that to the top of year 2. And I kind of just built a schedule and said, okay, next year I'm gonna have another 13, I'm gonna use not 7,500 hours, but 87% of those employees are still here. So I'll use 6,500 hours in year 2. Then 99% of that's gonna be forfeited. And then I built a schedule all the way out for 5 years. And that's how I determined that next year I'm gonna use 7,500 hours entity-wide, 17,000 hours will be used at some point in the future. The rest of it's going to be forfeited. Is everyone with me? Yes.
Yeah, so make sure that I follow you. So basically you look at the number of hours that they accumulate and you use up like percentages based on experience.
Yep. So what I did is I go, okay, I have a giant report that I'm able to pull, luckily, data from my system, sick leave that is used or sold. So it's hours. I pulled hours out of the system for 5 years. I said, okay, this is the leave code is what you probably 301. I don't know if you remember that, Jen. And this is how many hours have been used entity wide throughout the whole 5 years. I divided that by 5, 7,500 hours per year are used. So that was how I determined the number of hours to accrue. Any questions with the methodology? Awesome. So rate of pay, they already kind of went over this. Luckily for me, I do my payroll report at June 30th. We have to post per, I forget what the ORS is, but we have to post monthly salaries for all of our employees. So I use that report to know exactly what everyone's amounts are at year end. So hourly rate of pay, also make sure to consider incentive pays. I have a sheriff's department that has an incentive pay. My county administrator says they have an incentive for being left-handed. So they have an incentive for everything. Whenever they sell vacation, their incentive pay is included in that. So I have to take their salary hourly rate of pay plus all their incentive pays. Plus I make sure to include Social Security, Medicare, paid leave Oregon. If that's employer paid, most of us are paying that. So if you have less than 25 employees, you're not paying that. Unemployment insurance, and we pick up the IAP portion of PERS. So I also include that 6% in my calculation because that is a defined, not a defined benefit, but a defined contribution. So that should be included in your rate of pay. Any questions on rate of pay? Awesome. So now I have all the hours I want to accrue. I have the average rate of pay. Sorry, let me back it up there. So what I do is I get a rate of pay by person and then I average it by leave plan. Not entity wide, but by leave plan. So like I have 2 unions that have vacation sick. So their rate of pay is higher than my AFSCME group of people who are FET. So average rate of pay by leave plan. Then I have to figure out, okay, now I know what my liability is. My current liability is 403,000 for sick and 936,000 long-term. But those of you who build financial statements know that we have to accrue the expense by function. So now I have to go backwards. I go, okay, I have employees that are split between general government and, highway and streets. So how am I going to accrue that expense? I have the entity wide. Now I have to go back and do it by function. So what I did is I said, okay, what is the value of the leave if I accrued it at 100%? And I came up with $2.1 million. But I know I only want to book 403,000 for a current and 956,000 for long-term. So I said, what percentage of that is of the total value of the sick leave if I accrued it at 100%? And then I applied those percentages by employee. So finance manager is 100% general government. Say he has $24,000 in sick leave if I accrued his at 100% at the end of the year. Well, he has an 18% chance he's going to use it next year and a 40% chance he's going to use it in future years. So that's how I did it by function. Public Works Director, he's split, so he's 85% highways and streets, he's 15% parks and culture. So I said, okay, if he's got $30,000 of sick leave at the end of the year, 85% of that needs to go to highways and streets, 15% of that needs to go to parks and rec. And of course, then I go, okay, well, 18% of that liability is current and the remaining is long-term. Not remaining, 40% is long-term. Does that kind of make sense, that methodology? Awesome. All right. To Jen's point, PLO is a whole new thing. People are using way less sick leave. I'm going, okay, I know what people did 5 years ago. So what I'm going to do is maybe in the next 5 years, I'm going to do another analysis and go, okay, now people are using less sick leave, and now I can do whole new calculations. Maybe people are leaving more often. Maybe our organization is, maybe we had a bunch of layoffs because we no longer have Medicaid funding, which is very scary. But every 5 years, I think I'm just going to pull the data and kind of just review, make sure that our trends are keeping up with employment trends.
That was a new concept to me. I think doing it only every 5 years, you don't envision needing to like reallocate or reanalyze annually in order to get those ratios, just.
We could, but that just seemed like a lot of work, so I decided
Not necessarily, go forget that.
The percentages are not gonna change for a few years. But you'll have new numbers each year, right?
Right,
Yeah.
okay.
But yeah, trending. Yeah, I just decided 5 years seemed reasonable at the time because I did a 5-year analysis. I was like, well, I mean, if I look at this in 5 years, that makes sense. But if you do it more often, it's going to be more accurate.
Right, but I like 5 years.
That's what I thought. I thought it was reasonable. Well, what do the auditors think? Is 5 years reasonable? Unless there's a material trend, then you might want to reevaluate if there's a material trend like a bunch of layoffs due to Medicaid funding.
But sorry. I was gonna say your first 5 years, I think is a great 5 years because it includes a couple before COVID and then it includes the COVID and it includes the PLO. So I think you get a good, that's a good.
Yes.
Do you allow, contract, allow your employees to make themselves whole with PLO using accruals?
Yeah, so we're very hands-off with PLO. We say they can do whatever they want. It's between them and the state. So they can take as much sick leave they want. We don't tell them. I know the state's very strict and says that you can only supplement, but if somebody were to be 100% paid county and be on PLO, we don't tell them no.
Okay, so that's a little bit different for us. So what, the approach we've taken is they have to tell us how much they're getting in PLO. We do a calculation that says, then here's what the dollar difference is. We translate that to the use of accrual hours. And I guess my question is, does that go into the use number?
That would, because if I am reducing sick leave and I'm pulling data from time cards. So if they're putting sick leave on their time cards.
And they aren't,
Ooh,
because it's us doing that calculation of what dollar amount would make them whole. We're translating that to a number of sick hours and reducing their sick bank by that. They are not entering sick hours for that.
and when you run your reports, are you able to pull adjustments?
Mhm.
Then I would include those definitely in the adjustments because you are using sick leave and assigning cash to it. So I would have to pull that in. Luckily, we do all of ours on time cards. We have the employees, all the employees' responsibility.
Just let them do what they want.
Yeah, that, I feel for your payroll department, HR department, because that is not ideal. It's not ideal anyways, because we also have the retroactive PLO approvals. Those are the worst. Okay. All right. Any other questions?
And realize that obviously this, you gotta go back and do this for, you sort of gets 23, because you have to have a balance, correct?
Yeah, so you do have to restate your beginning balances. So I did both of my compensated absences at the same time. I did it the old way and I figured out this new way for last year's numbers because you will have to restate your beginning balances per GASB 100. All right.
Okay, thank you, Tara. We have food over here. On your table, I think everybody has a wine bottle opener. They have a very nice selection of wines downstairs. After hearing about 101, maybe we all need a drink or two, right? So, we'll break for lunch. Let's try and be back at 12:45 for lunch so we can get everything done because there's still a lot of material to cover today. So thank you so much.
It's silly. All the. Yeah.